Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Matt, the mortgage guy. How you doing, buddy?
I'm doing good, trying to stay dry and safe in this storm.
Oh, you got to, yeah. Is it raining up in Sacramento?
No, just the market.
Oh, you meant the mortgage market.
The
I'm like, it's beautiful weather here. Why the hell is it raining in Sacramento?
It's probably sunny outside weather-wise, but
Yeah.
in the mortgage market, a little turbulence.
So, as you know, I've been looking at the markets for 30 years. And the last 5 trading days, so Thursday, Friday, Monday, Tuesday, Wednesday, I have seen moves in the 10-year treasury that, generally speaking, takes months to move. And I'm just going to guess that the mortgage market that you see, you've probably had 3 repricings at least Thursday, Friday, worse, Monday, Tuesday, better, today, worse. But I'm just guessing. What's going on in the mortgage market?
Yeah, for sure. And we've talked about this before, but it's worth noting so that people understand, when you hear that mortgage rates change every day, sometimes they change multiple times per day. And so, pricing comes out in the morning, 10-year treasury goes up or down 20 basis points. You're going to see lenders, 9:43 a.m. reprice for the worse. 11:52 a.m. reprice for the worse. And so we've seen not just, mortgage rates being super volatile and moving, but multiple times per day. Today being no exception, because I think last I saw, the 10-year was back up 16 or 17 basis points to 377 or 378. And so rates are getting worse. And so it has never been truer than it is right now. If you like it, lock it. There's no reason to gamble. And, the trajectory right now, until the Fed says something about pivot, until the Fed, starts to change their mind, is an upward trend on rates. So there's really no reason at all to not lock right away. I feel like I've got to pound that into some originators' heads. If you're an end consumer and you're thinking about it, tell the loan officer you're working with, just lock the dang thing.
Lock it. Yeah, exactly. And again, you and I talked about this. You've been on this show for more than a year now. One of our first conversations, you're just kind of introducing yourself to the audience. It's like, yeah, loans get, or rates get repriced, once a day. On a hectic day, you might get, a morning and then an afternoon repricing. It wouldn't shock me if you've had, I'm just going to guess, 4 repricings one of these days. I mean, it's just been nutty.
Yeah, 3 or 4. And what's been interesting, Mike, is in this volatile time where, lenders run businesses. They don't have dummies in their secondary markets who are controlling these pricings. You will see a day where, the 10-year treasury comes down quite a bit and you're expecting this huge betterment in rates. Yeah. They give you back 20 or 30 basis points, right? But
a little.
They don't want to give you a lot, because they know the very next day, 10-year treasuries back up and they've got to reprice. And so it's been interesting to follow that, where you're like, ooh, we're 80 basis points better, 90 basis points better. We had a great day on Monday. Lenders only gave you a little bit back, because they see the writing on the wall as well. A day like today, where we're 75, 80 basis points worse on mortgage-backed securities. The rate sheets are definitely going to reflect that, and you're going to get, almost every lender's going to reprice from the worst from what pricing was when we opened today.
So I remember last Tuesday, I think, because I remember on Monday morning on my daily financial news, this was last week, so call it September, whatever it was, 28th or whatever. I asked, when do we hit 4%? And I was thinking next month. And then literally Tuesday evening or late afternoon, we hit 4% on the 10-year treasury, which I believe took mortgage rates to over 7. I think what I saw was 7.08. I think we're generally down from 4%. Even today's move, I think we're at like 3.77 on the 10-year. I'm just going to hope and guess that 30-year rates are sub 7, but I don't know that.
Yeah, 6.95, Mike. Real.
So rates are under 7.
Woo! Yeah. And that's I just if anybody asks, I'm just going to quote Mortgage News Daily. It could be higher, it could be lower. You could have perfect credit, you could have bad credit. 30-year fixed on a primary residence for people with great credit and not paying a lot towards rate buy down. High 7, 6.95 is where this national average is at. We might talk in this video or later videos about all kinds of creative stuff people are doing because they don't want to pay 7% interest. So there's different ways that they can go about not paying 7%.
Well, let's talk about that. We'll do it right here because again, the beauty of my channel is I have other experts and millionaires come on my channel with their domain, but I get to tie them all together. Right? We had Beth, a top 1% agent in the country, tell us that her market crashed 50% in transactions when rates hit 6. Well, folks, for all intents and purposes, we're at 7. And we're heading into winter. June was summer, a good time. We're now in October, generally speaking, a bad time. This housing depression that I'm calling is like right in front of us. So if you're somebody that is buying, has to buy, house hacking, whatever it is, what are some creative ways you're seeing people either buy down the rate? Because again, 6.95 sucks. People are not used to that. And especially today's prices, that's no good. How can they get something in the 5s with 2 or 3 points? What's going on today?
Yeah, for sure. So there's a couple, like the most common ways. I'll talk about the 2 most common. One is one that probably everybody knows. You get a big seller credit, you buy it down the rate, and then you say, okay, with this 10, 12, 14,000 in seller credit, we can buy down a rate to 5.99% on a 30-year fixed. We're fixed at that. 5.99 sounds a lot better than 6.95. Off we go.
Yes, it does.
Another one we've done a lot of, and I've really become a fan of it, even though you might look back 6 weeks and like you, I'm not going to ever take any videos down. I talked about some things I didn't like about the 2-1 buy down. Well, with a few little tweaks to it and seeing the power of it and how much, consumers liked it. I've wrote now a half a dozen of these things, and I've ran through the scenarios with almost everybody who's in the market to say, this is something you might want to consider. And a real quick example of it is someone's buying at about 500,000 with 5% down, all in. Their payment at 6.5% is probably going to be around $3,800 a month.
Oh,
and knowing that, that is a little bit of a stretch for some folks, you can present a 2-1 buy down. It has to be seller funded. So this is not the buyer's money. This is the seller's money. And, we're in a market where sellers are playing ball. Just rough figures. One we recently did that comes to mind: 4.5% year 1, 5.5% year 2, and then years 3 through 30, it locks in at the 6.5%. And really that locked in rate is you can have any rate you like. You can do similar type buy downs from the buy side to get to that, right? And then you get a 1% discount the second year and a 2% discount in the first year. This is going to allow that same buyer to have a payment like $700 cheaper, like $3,100 in year 1.
Right, for the first year,
yeah, $3,450 or something in year 2, and then it goes to $3,800 for years 3 through 30. A couple things: never gonna guarantee somebody that rates will go down and that you're guaranteed you're going to be able to refinance into something lower, but it's a possibility. And I think most of us would say, sub 5% rates sometime in the next 36 months is something that folks would bet on. The Fed overdoes it, they have to retract, rates come back down. Not a guarantee, right? But a possibility.
Certainly sub 6,
right?
Sub 5, sub 5. I wouldn't tell anybody sub 4. Those days are gone. Probably.
Yeah, I wouldn't bank on that either. That's why I kept it to sub 5. I don't want to over
realistic.
Yeah. Right. And so if somebody refinances within the first 2 years, that seller subsidy that's helped them save $700 a month and $350 a month over 2 years, whatever is left, they get back. They get back in a principal reduction. And so that money is not lost, different than paying points, where you refinance out of a rate where you paid points to get it. That money's gone, right? You refinance 9 months later, whatever you paid up front, and whether it was you or the seller, 12, 14,000, the money's just gone. In this case, it sits in an escrow account and it gets refunded to you. And what I think I like about this is, like, people are writing loans at 6.5%, 30-year fixed right now as it is. That's your worst case. You actually have a ceiling. It's not like an ARM where there's a 5 or 7% band, right?
Worst case, 11.5. Whoops.
Yeah, I mean, because imagine if you wrote like, a 5-year ARM that was at 4.5% or 5.25%, and it could go up to 10.25%. Most of them can stretch 5%. Then you're
sure.
in, you know, a $4,600 payment, which I know is going to stretch this buyer. You're going to qualify at the highest rate. So we know the debt to income ratio aligns with what you can afford. Even though I know people, like, I personally don't want a $3,800 a month mortgage payment, and most of my clients don't either. But you'd have to qualify for that. You just get those savings in year 1 and year 2 that are funded by the seller. And if you don't use all of those funds from the seller, you get a principal reduction in your refinance when you refinance it. So that is something that is really common, and I'm seeing it more and more.
Yeah, the other thing I wanted to ask you about that I'm pushing for, and I'm going to call them combined loan to value because I'm not really sure what to call it, but I'm actually making offers now where I'm asking the seller to take back 20 or 30% at a lower rate. Like, for example, I get a loan from you at 7, but I get, 30% at 3%. My blended rate is like 4.8 or 4.9. Is that something that you can process via FHA, or is that more non-QM?
I'm pretty sure that's on the non-QM side. I don't think I'll double check into it, but I don't think any of the conventional lenders are going to want, a seller funded second sitting on the back.
You know what?
end of
I
it.
got a guess for you right now that is something that becomes very common next year.
Yeah. Yeah.
Because again, mortgage industry, banks are in the business of making loans. That's what fractional reserve lending does. We talked about seconds in home equity lines becoming more prominent, and they are. And now I bet you they allow combined loan to values. Because again, that's one way sellers could get their price, but you can get your terms and your rate.
Yeah. I mean, I think that I'm gonna just guess, and I want everyone to know that I'm guessing.
Pure
but
guess.
Lenders are doing first and seconds, right? And so I think that you're going to find ones that allow it, because Fannie and Freddie will say, yeah, we'll do this 60%. What you're going to run into is somebody trying to do the whole purchase, right? That combined loan to value can't be 100%.
No, real down
them,
payment. Yeah.
Yeah. Most of them are capped at 89.99, right? Like, you got to put 10% down, skin in the game as a buyer.
Absolutely. I'm okay.
But in my eyes, whether it's another mortgage company writing that 10 or 15 or 20% second, or it's the seller, shouldn't really matter.
Yeah, again, I'm going to tell you right now, I'm going to write a lot of those offers and hopefully get, several. And again, by doing this the right way, I can get my blended interest rate sub 5 really easy. I can even get it if I get a real low rate from the seller, get it below 4, certainly below 4.5. So again, blended interest rate, something I'm pushing for. So
I'm gonna look into that, because I think that's it. I mean, what the common theme is going to be, I think you agree, people are going to get creative when there's affordability issues. Creativity is something that, like, you're like, wow, that's a really creative idea, and it's born out of necessity.
Absolutely.
Right?
And again, this is a way the seller gets, because again, what's happening in a market is sellers fixate on price. I give a rat's ass about price. If I can get a number and the terms that give me 20 years, I believe Fresno would be more valuable in 20 years than it is today. So I'll do the terms, you get your price, I'll pay 800. I'll put 10% down or 11%, whatever I need to. The seller gives me a carry on the second. Bingo, bango, I'm paying 4%, 4.8% blended. I'm happy.
Yeah. And for some sellers, price does matter, and terms matter less. So somebody who owes 300 grand on a house that they're trying to sell for 800, they want to move out of state, 10% down, they carry, 220,000, and then you get a bank to finance the 500.
Done.
They might do that 220 at 1%, as long as they're getting their price, And
yeah,
so
I the best example I have for you is a couple of years ago, I don't know, it's been 5 or 6. There was a seller that wanted 120 for a 100 house. He wanted to tell his friends he was smarter than the buyer. So I got him for a 1% 30-year mortgage, back when rates were 7 or 8, 6 or 7%. So
nice.
I'm sure he never told his friends he gave up a 1% mortgage, but I bet he tells everybody that he bought, sold some sucker 120 for a 100K house. So
right.
It's going to be fun. I think again, people that are creative are going to win. I think sellers are going to get to a point, if they want to sell, they're going to have to work with guys like me, and I'm chopping at the bit to get some blended rates sub 5. So Matt, if they want to work with you, how do they reach out?
Go to greatmortgagebroker.com, fill out the form. We'll be in touch very shortly. We're in 46 or 47 states. So chances are we're going to be able to, help you out. Greatmortgagebroker.com.
Awesome.